Welcome back to Synaptic Dividends. We're all about breaking down dividend stocks to help you build that passive income portfolio. And hey, if that's what you're here for, make sure you're subscribed so you don't miss a thing.
All right, today we're diving into a real legend, Brown-Forman. You know them? They're the company behind Jack Daniel's, Woodford Reserve, absolute classics. But the big question for us, as always, is this. Is their dividend as strong and reliable as their whiskey? Or is there maybe a hidden risk we should know about? Well, let's dig into the numbers and see what they tell us.
Okay, so first things first, we always have to check for safety. I mean, the number one question for any dividend stock has got to be, can the company actually afford to pay it? Is the cash really there? And to get the real answer, we look at my favorite metric, the free cash flow payout ratio. Now, all this really means is, what percentage of a company's real leftover cash profit gets used to pay out that dividend? Think of it like a company's household budget. It's the truest measure of affordability because it cuts through all the accounting fluff. So what's the magic number for Brown-Forman? Well, over the last 5 years, their average free cash flow payout ratio is 67%. Now, just to give you some context, pretty much anything under 80% is considered super healthy. So at 67%, whoa. Brown-Forman isn't just covering its dividend, they've got this huge 33% cash cushion left over. That's cash they can use to reinvest in the business, pay down debt, or just handle whatever curveballs the economy throws at them. That, right there, is a fantastic sign of safety. Okay, so the dividend is safe, check. That's awesome. But safety, it's only half the story, right? A truly great dividend stock also needs to have a long, proven history of actually rewarding its shareholders. So, has Brown-Forman really walked the walk over the long haul? Get this, for 81 consecutive years, Brown-Forman has paid a dividend. 81! I mean, that is just an incredible track record. We're talking multiple generations, world wars, all kinds of economic craziness. It really shows you that rewarding shareholders isn't just a policy for them, it's basically baked right into the company's DNA. But hold on, it gets even better, because the company hasn't just paid a dividend for all that time, they've increased it for 41 straight years. 41! That puts them in that super exclusive club, the S&P 500 Dividend Aristocrats. And that's not just some historical fact, it's a powerful signal about their future intentions. And this table here, it really shows you the power of that commitment in action. Just look at that 10-year average growth rate, a fantastic 6.8%. That's consistently beaten inflation. But here's something important to notice. See the one-year rate? It's 5.5%. Now that's still really solid, don't get me wrong, but it is a little bit lower than that long-term average. And what that tells me is that management is being smart and a little cautious in the short term, given the economy. But they're still absolutely honoring that long-term commitment to growth.
So a great track record in good times is one thing, but what about the bad times? The ultimate stress test for any company, for any dividend, is how it holds up when everything seems to be falling apart. So how did Brown-Forman do during the biggest economic crises of our lifetime? Well, here's all the proof you need. During the 2008 financial crisis, you remember, when banks were literally collapsing, they raised the dividend. Then, during the 2020 global pandemic, when the entire world just shut down, they raised the dividend again. That just speaks volumes about how resilient their business is. It seems that premium spirits are a kind of affordable luxury that people just don't give up, even when times get tough. It's clear that management's commitment here is absolutely unwavering. All right, so we've looked at safety, we've looked at history, and we've looked at how it performs under extreme pressure. Let's pull all this evidence together and deliver the final verdict.
So when you lay it all out, 3 key things just jump off the page. 1, the dividend is easily covered by real cash flow. 2, it's backed by more than 4 decades of nonstop growth, which is what makes it a dividend aristocrat. And 3, it has proven time and again to be completely crisis-proof, growing right through the worst economic storms you can imagine. When you put all those pieces together, the story the numbers tell is crystal clear. They paint a picture of a dividend that isn't just strong right now, but one that is safe, that is growing, and that is absolutely built to last for the long haul. So the numbers confirm the dividend is as strong as the whiskey. The only question left is, at today's price, is it a bargain? If you want to go deeper and understand the full business model and valuation behind these numbers, check out our long-form analyses on our main channel, Synaptic Investing. And of course, if you found this breakdown helpful, a like is always appreciated. And be sure to subscribe for more dividend analyses. Thanks for watching.